The road to retirement can be made easy if we properly use retirement accounts, as they are a great way to not only save for retirement but also to save more money in taxes. So in this video, we are going over the most common type of retirement accounts and what the differences are to help you decide which ones you should get. We will be talking about 401k, Roth 401k, IRA, Roth IRA, and HSA, which isn't really a retirement account, but you can choose to use it as one. Now, whenever you see Roth, that means you're going to contribute to the account after paying taxes and won't have to pay taxes later when your investments grow and you withdraw your money. On the other hand, with traditional retirement accounts, you don't pay taxes now and pay it later when you withdraw. Both of these are different from a non-retirement brokerage account where you put in money after paying taxes, and when your investments grow and you sell them, you have to pay taxes again on the gains you make. So these retirement accounts provide tax advantages either at the time you put in the money or when you take it out. However, you can only withdraw your money at retirement with these accounts, except for a few exceptions, and you have to pay a penalty if you withdraw before a certain age. 401k is an employer-sponsored retirement plan that allows employees to contribute a portion of their wages to a retirement account. How it would work is that you would fill a form with your employer every year telling them how much you want to contribute to your 401k, and then each pay period, this amount would be deducted from your paycheck you get to be put in your 401k account before paying any taxes on it. You would pay taxes when you withdraw your money from your account at retirement age, which would be after 59 and a half. Employers also usually match your contributions up to 1%. It can be something like a 1-to-1 match up to 5% of your income, for example, meaning they will match every dollar that you put into your 401k account for up to 5% of your income. So if you have a salary of $100,000, for example, you contribute 5% of your income, which in this case would be $5,000, they would contribute an additional $5,000 to your account for a combined contribution of $10,000 on which you won't be paying taxes. Some employers have a 2-to-1 match, meaning they would put twice as much, and some employers put $1 for every $2 you put in. It really depends on the employers how much and up to what percent they put into your 401k account. But whatever it is, make sure you're taking advantage of this match, because this is free money that you won't be getting if you don't contribute. Also note that you have to start taking money out of your 401k once you turn 72. The Roth 401k is very similar, but the main difference is the timing of taxes. Instead of being taxed later, you are taxed when you put your money into the account. So you have less money to start with compared to traditional 401k, but you also won't be paying any taxes on whatever gains you make over the years. Note that if you go with the Roth option for your 401k, the money that your employer matches would go to the traditional 401k. There is also individual retirement account, or IRA, which you can get in addition to your 401k. IRA has nothing to do with your employer and you can get it on your own. You can open an account online at any brokerage firm like Charles Schwab, TD Ameritrade, or many others. When you contribute, you can deduct it from your tax returns, thereby not paying taxes on it. You also have a lot more options for investing, as you can invest in individual stocks, unlike the 401k, which typically allows you to invest in a fund. But with IRAs, you can only contribute up to $6,000 a year compared to $19,500 for a 401k in 2020. The withdrawal age is the same at 59 and a half, and just like the traditional 401k, you have to start taking money out at 72. The Roth IRA is similar to a traditional IRA, with the main difference being, again, timing of taxes. So when you withdraw your money after 59 and a half, you won't be paying any taxes on it, and there are no required minimum distributions once you turn 72 either. The Roth option does, however, have an income limit for contributing to a Roth IRA, unlike a traditional one. You can only contribute up to the $6,000 limit if your modified adjusted gross income, which is just your gross income minus some deductions and plus some other deductions, is $124,000 a year as a single, and can contribute some of the $6,000 if your income is between $124,000 and $139,000 a year. If you're making more than $139,000 a year, you cannot contribute to a Roth IRA but are allowed to contribute to a traditional IRA. A health savings account, or an HSA, also helps you save in taxes and can be used for retirement. It is a tax advantage account for people with high deductible health insurance plans. and their purpose is really to help you pay for healthcare expenses with tax-free money. You can make tax-deductible contributions of up to $35.50 every year, and if you use it to pay for healthcare expenses, you don't pay taxes when you withdraw either. So you never pay taxes if you use it for healthcare expenses. You can also use it as a retirement account because once you turn 65, you can use it for anything but would have to pay taxes at withdrawal. So this works like another traditional IRA for non-healthcare expenses once you're retired, as you don't pay taxes first but pay taxes later. So which ones you should get depend on a lot of factors, as there are pros and cons for each one. I think anyone with a high deductible health plan should definitely get an HSA, and then at least one of Roth or traditional 401k and at least one of Roth or traditional IRA, depending on your view of taxes. If you think you'll be at a higher tax bracket at retirement, get the Roth options, because with Roth, you're paying taxes at whatever rate you're in now, and when you retire, instead of being taxed at whatever higher rate you will be at, you won't be paying any taxes. Or maybe you get both options for IRA and 401k to hedge this future tax uncertainty. Note that if you get both, your total contribution would not double but will be the same as if you were getting one of them. What I would do is maximize my employer match for Roth or traditional 401k first, and then maximize my HSA and Roth or traditional IRA. After that, I would put money in a taxable account, as you have the flexibility to use it at any age and have more flexible investment options. Or you can put more money in your 401k if you want to contribute more towards your retirement and let your money sit in a fund. Well, I hope this video was helpful in understanding how effective these tax advantage retirement accounts can be. Make sure to give this video a thumbs up and subscribe to my channel if you'd like to see more videos like this.